Now, let's talk about the metals as well as the cement space. We have Pinakin Parekh, Executive Director, Metals and Mining, Oil and Gas, Cement at JP Morgan India, who joins in. Hi, Pinakin. It's been a while since we had a chat. Thanks so much for joining in. Well, what's your view? China is reopening, which has given some legs to base metal prices. Even ferrous, actually, steel prices have bounced up. Do you believe the worst of pricing is behind us in terms of steel? And also give us a sense about post the recent cut in domestic prices and Chinese price moving up. What's the gap now between the two?
Sure. Thank you, Nigel. Good morning, everyone. So since the end of October, there has been a divergence. Copper prices are up 15%, iron ore is up 40%, and oil is down 15%. Essentially, this is on the narrative of China's moving away from ZCP or zero COVID policy, and the noise and the news flow continues to indicate that there should be a reopening which would drive demand higher. Chinese steel prices are now near $575 per ton. Landed in India, this works out to around 50 to 53,000 rupees a ton, which is broadly similar to where domestic prices are after the last round of cuts we saw in the first week of December. Now from here, the big surge in Chinese demand should come after the Chinese New Year in mid-Feb, when mobility levels would increase further, and this should further drive up Chinese HRC export prices. So in our view, domestic steel prices have likely bottomed, and in fact, going into the first quarter of next year as import prices rise, there could be some upward movement in domestic steel prices.
Pinakin, are you expecting a very vigorous upsurge in prices of both metals and oil as this faster reopening in China materializes, or not really? What are your global colleagues also saying on this? Yeah.
Sure. So at this point of time, 2023 looks to be similar to 2022, which is basically it will be very volatile. Our global view for Brent prices is $90 a barrel. Now, these implies roughly a 30% upside from here. But to give you a sense, we were at $90 a barrel only 2 to 3 weeks back. Similarly, for base metals and iron ore prices, our view is that prices remain firm. However, it is the path that the prices will take over the course of the next 6 to 9 months. So over the next few weeks, as China moves from announcements to policy support to activity on the ground, there would be a demand increase. However, a V-shaped demand recovery is unlikely. You will have demand in stops and starts, but through the next 6 months, Chinese demand will be higher. European demand has not collapsed as was feared. Gas storage has been pretty good, but again, that's a moving number. And US is also doing underlying, fundamentals are well. So commodity prices should remain firm. But again, don't expect a repeat of 2002 commodity prices in terms of how prices went up very sharply.
Okay, Pinakin, good morning and thanks for joining in. You track the cement sector very closely as well, and I was going through your recent note where you do speak about how energy costs are declining, demand has come back in a big way, especially with government infrastructure projects, and things are sort of working out for the cement sector. In that context, do you see further upsides both in terms of earnings as well as stock prices in the near term, say in the next 12 to 18 months?
Sure, Sonia. So the biggest driver for cement stocks this year has been power and fuel costs, which doubled over the course of calendar year 22. Basically what happened on pet coke and thermal coal prices. Now in September, October, warmer winter in Europe meant gas prices fell. That also drove thermal coal prices sharply lower. There was also rub-off on pet coke prices. Since then, winter has come back again in Europe. Temperatures have fallen. Gas prices and TTF prices are higher. That has also pushed thermal coal prices higher. So from here, at this point of time, any big decline in power and fuel costs looks very unlikely. Cement price hikes have taken place, but they seem to be more regional in nature, not across pan-India. So in cement, our view is, if you contrast this with metals where consensus estimates are too low, in cement, consensus is probably a bit on the higher side for next year. So, our sense is that positive earnings surprises would more likely come in metals than they would come in cement. Cement, one has to still take the call of multiple expansion on a broader India capex theme.
All right, Pinakin, from the steel space itself, you like the integrated players more?
Sure, Nigel. So when iron ore prices move up 40%, when Chinese steel prices move up the way they have done, Indian steel industry generally does well because they have lower iron ore cost. And within the Indian steel companies with lower iron ore cost with captive mining tend to do better than the non-integrated guys.
Okay, so you prefer, so, just to tell our viewers, Pinakin's not talking stocks, but, you have Tata Steel and SAIL, they are more backward integrated on the iron ore front. Pinakin, JP assets, they could all probably be on the block. That's what they have told the exchanges. And I wanted to ask you, strategically, who does, who's best positioned to take advantage of these assets if it comes to that?
Again, Nigel, no company-specific comments will make. But in cement, obviously, M&A is a theme which has been going around for the last few months. The large guys have laid out an aggressive capacity expansion plan. So at this point of time, again, the industry is divided among the larger and smaller guys. So it will, depending on the size of the asset which comes up for sale across the board, you would always have a bunch of buyers. But again, difficult to pinpoint as to who specifically benefits or who specifically would look at the asset.
All right, Pinakin, we'll leave it at that. Thanks a lot. All right, just hold on for a second. We have a couple of more questions for you, but there's a new listing as well. So let's take one look at that. 2% lower on Uniparts India. It's listed at a discount. Now, remember, this is a company that manufactures a lot of, components for the agriculture, the off-market business, the construction business, mining, aftermarket sector. So it's basically an auto component player. But it's had a muted listing. I mean, weak listing, actually, you'd have to say, down almost about 2% The growth actually has not been too bad, but only thing that the customer profile is not one of the marquee prominent names. It's slightly lower rung category, so do keep an eye out on that. But otherwise, a strong margin business, about 22% margins is what it does. Over the last many years, it's about a 16-17% compounded growth rate. So you'd have to say subdued listing coming in for Uniparts, but more on that in a bit. Pinakin, I just had one follow-up question. You were talking about how the costs have come down, but do you think that there is a possibility of a large cost deflation? Because the petcoke prices, thermal coal prices are still on the firmer side. I'm talking about cement. In that context, do you think it's unlikely to see large cost deflation?
Sure, Sonia. So our view is that large cost deflation is very unlikely for the one fundamental reason that Europe's gas issues have still not been sorted out. So by Feb-March, the storage becomes an issue. They come to the spot market to buy gas. And when Europe goes out and buys spot gas, it will have a cascading impact through the energy chain. Coal prices, petcoke prices, spot LNG prices all move higher. So our view is that maybe costs have peaked out, but clearly we are not looking for costs to revert back to what they were in calendar year 2021 unless European gas situation eases out completely.
Pinakin, any interest in looking at oil marketing companies after the horror show that 2022 has been for them?
Sure. So in terms of, we did recently upgrade downstream versus upstream, a couple of weeks back. Our view is that, look, while Brent prices will remain firm, the worst is clearly over in terms of a surge in Brent prices. So even if oil prices remain at $85–90 a barrel for the next couple of years, you are better off within the energy chain in the downstream space versus the upstream space. So to that extent, our view is on the margin. Clearly, the worst is over in terms of earnings for the downstream companies within the Indian energy space.
All right, Pinakin, we'll leave it there. Thank you very much. Good conversation as always. And thank you for your time. I mean, right on cue, as we finish up this conversation, the market has come back into the green. Look at that. I mean, the Nifty will come up. It's just now ticked into the green. We're up 4 points now. So this is quite something, isn't it? Sharp 150-odd point cut. And you've got all of that now erased. And it's a new story, new day, almost a new week in that sense. And we are back up. IT is rebounding. Banks have come back quite nicely. So I think it'll be interesting to talk to Mitesh in terms of how he's seeing this rebound. Take that break. We're back with that in just a bit.